Hello, traders. In this video, we'll discuss some new income producing strategies for the week of March 4th. As always, these strategies are meant to be simple, straightforward, and consistent ways to produce income on a weekly basis. We opened a credit spread in Rivian on Friday with the May 17 expiration. We sold the 10 put and simultaneously bought the 750 put for a credit of $224 for 4 contracts, with $776 as cash aside that Schwab will hold until the trade is complete or we close it, while selling the credit spread at the low intraday. That was a 20 delta, and we bought the 7 delta with a $1 a day theta and over 100% in implied volatility to capture some additional premium. We also took an iron condor on Target after earnings to capitalize on a $135 credit with a $365 cash held for each contract that we chose to take, expiring on May 17th. If Target stays within these short strikes, the red lines, we will make 100% of that credit received. If for some reason it approaches one of these short strikes overhead or below, we'll close the side that is being tested and roll the upper or lower strikes to capture more credit. We took a iron condor on Tuesday, anticipating Target staying within these verticals, producing an iron condor for a credit of $135 per $365 in cash held to sides for more than 30%, with IV being right around 25%. Now, we could have chosen a higher implied volatility, but we wanted to stay safe with a delta around 20 on the short strikes, the red shading, giving us an 80% probability based on option pricing of a successful trade. We also took a credit spread on Meta, suggested on Thursday, using the 328 expiration for a credit of $136 per $864 in cash held aside initially, but looking for a higher credit if we could see the price action dip first. IV was 30%, deltas were right around 17, with theta of 20. One of the things that caught my interest. Implied volatility of 30% for this short duration credit spread. In addition, we took an iron condor for Abercrombie & Fitch earnings. That turned out to be a great trade on Friday, with $300 in credit received, 3 contracts, $915, about a 50% return on investment. In this position, we were looking to capture this implied volatility premium as earnings came out and collapsed, trading a 23 delta on the call side and a 16 delta on the put side, something that we like to do, that we have high conviction will stay within a tight range. Criteria, we usually look for 15 to 45 days till expiration, looking for options that have volume and open interest so we can get out if we need to. Selecting a delta of 20 or lower, that's easily found in your brokerage option screen, giving us about an 80% probability based on options of a successful trade. Looking for implied volatility of 30% or greater, and selling on the dip after the stock bounces, giving us the best entry. In most cases, we're bullish the stock, so we're looking to sell put credit spreads for consistent weekly income. Okay, so that's credit spreads and iron condors for this week. I'm your host, Cousin Vinny, coming to you from theclosingprint.com. If you would, like and subscribe to the video and post any comments that you'd like for us to cover down below. We'll see you in the trading room again this week.